question is, okay, was the 53.55 that peak? Was that a bubble? Is this the end of gold? Should I out? Is it going to be more, et cetera? Or is where we are kind of finding a floor, good entry point? Don't have full gold allocation. If you want more, is this a good place to get in? We said gold. Yes, we might like to go in this game. We just saw gold on the big hands or the strong hands and gold. They need the dollars to buy oil. People like them. So that is a very simple explanation for why gold started down. If gold peaked down in January, inflation still concerned. What was coming out of the Persian Gulf was basically the lifeblood of the global on. Okay, I'm going to jump on the bandwagon. So they start selling it because it's going down. There we go, and that's selling. It was going to be so tight. And this is something to look at. So when we come out of the gold time, about a 50% drawdown along the way. So here's my base. Here's my peak. Take half the difference, subtract it. It comes out around $3,600 an ounce. Now,
so Jim, of course, we need to cover precious metals as well. We have seen gold and silver being, of course, they had a great performance over the past 2 years. Now they're sort of being stuck in this wide range. I know some people, Jim, they're trying to find some similarities when 2011, well, we had this big run, and now, well, we could have a lost decade for precious metals. Where do you stand here, Jim?
Yeah, great question. I hear the same question from a lot of investors and interested parties. So let's start with the facts. That's always a good place to start. So gold peaked at the end of January 2026 around $5,355 an ounce. Some people, that was a closing price on the COMEX. Some people pick a higher intraday price. That's fine. There are different tickers, but that's about where it was. So call it 5,400 an ounce for a round number, if you like. It then went down in just a little over 6 months to $4,000 an ounce. It was a little actually. There was a three handle there for a little bit. It ticked down to around 39.50 or whatever, but about $4,000 an ounce, maybe. I mean, it obviously moves around. It could be 4,100 today. So that is well over a 20% decline. That is a full, pardon me, that's a full-scale bear market, if you want to use that expression.
Markets are celebrating stability, while gold has already endured a textbook bear market decline. Jim Rickards notes that a 20% correction is emotionally painful, but historically normal inside powerful secular bull markets. The bigger question is why so many investors treat volatility as failure instead of price discovery. Those who panic during resets often surrender future gains to institutions accumulating patiently. Next, Jim Rickards reveals why today's pullback differs fundamentally from the collapse many investors still fear.
So the question is, okay, was the 53.55 that peak? Was that was that a bubble? Is this the end of gold? Should I get out? Is it going to go down more, et cetera? Or is where we are kind of finding a floor, good entry point? If you don't have a full gold allocation, or if you want more, is this a good place to get in? And the answer is yes, it is a good place to get in. I definitely recommend that. Now, having said that, let me offer a little explanation behind that, because I don't want to just, kind of throw that out there. First of all, the fundamentals have not changed. Central banks are still net buyers. Market uncertainty is still huge because of the war in Iran and the war in Ukraine and other factors. Inflation is still a concern. And there are a couple other drivers, but the mining output is still flat. I'm not saying mining output is declining or peak gold, but it's been flat for 7 years. So when you have flat output and increasing demand from central banks, and that by itself is a recipe for higher prices. So that has not changed. So what happened? Well, the one big thing that happened is the war in Iran, and the war in Iran started at the end of February. Gold peaked around the end of January, but you can kind of see it coming. But here's the basic dynamic.
Central banks continue buying gold while many headlines imply the bull market is finished. According to Jim Rickards, the underlying drivers remain intact despite sharp price weakness. That disconnect challenges the official narrative because institutional demand rarely disappears before a lasting top forms. Investors focused only on price may ignore the forces quietly tightening long-term supply. Next, Jim Rickards exposes the overlooked chain reaction that turned geopolitical stress into temporary selling pressure.
So oil prices went from about $60 a barrel to $110 or $120 a barrel, depending on whether you're looking at Brent or WTI. Wet cargoes, like forget because Brent is a futures contract. It settles about 2 months forward. A wet cargo, a tanker full of oil, there's a market in that. I know some of the brokers in it. You want a vessel full of oil. You say, hey, I want this oil at my refinery in 10 days. I want to actually buy the cargo. You can do that. That was up to $140, $150 a barrel, which was not reflected in the futures price. That was, like I said, that's the spot price for physical. So that's how bad things got. Now, I don't have to recite all the statistics for what comes out of the Persian Gulf. I think most people know them, but 20% of the world's oil supply, 20% of the liquid natural gas, higher percentages of things like sulfur. People are like, what the heck, sulfur? What do you use it for? Sulfur is a precursor chemical in just about every important chemical process you can think of. So you start shutting down major chemical companies. Nitrates, what are they for? Fertilizer feeds the world. 1 billion people could starve if they don't get fertilizer in planting season. Helium, what is that for? Party balloons? Well, yeah, but it's also indispensable to semiconductor production. You literally would shut down semiconductor fabs if you don't have helium. So, and more, aluminum and other inputs, and refined product, also gasoline. So
Commodity stress often begins long before stock markets acknowledge the danger. What Jim Rickards is highlighting is that physical oil prices detached from futures, exposing supply strains hidden behind financial markets. That divergence matters because real-world shortages force capital to move differently than headline prices suggest. Wealth preservation starts by watching physical markets, not television narratives. Next, Jim Rickards reveals why this energy shock unexpectedly pressured gold instead of lifting it.
What was coming out of the Persian Gulf was basically the lifeblood of the global economy, if you will. Now, everything I just mentioned, oil, natural gas, refined product, gasoline, it's all priced in dollars. So when you increase the price to that extent, 50 to 100%, and it's in dollars, you need more dollars. Where are you going to get the dollars? Well, you sell gold to get the dollars to buy the oil. You might like the gold, unless people selling gold the big hands or the strong hands anyway, they don't hate gold, but they need the dollars to buy oil to keep the lights on. So that is a very simple explanation for why gold started to go down. If you look at an oil chart and a gold chart, you'll see they're inversely correlated over the last 6 months. So the beginning of the decline was not that people hate gold, it was that they were selling gold to get dollars to buy the oil. Okay, so now once that begins, what happens? Well, you've got leveraged traders. They hit stop losses. So they've got to close out their positions. So they're selling more gold on the futures market to cut their losses. That puts more downward pressure. Then here come the commodity trading advisors. They're just trend followers. They don't care if it's soybeans or gold. They're like, hey, I'm going to jump on the bandwagon. So they start selling gold because it's going down. And then you hit more stop losses. So it feeds on itself. So there's a very easy to explain dynamic.
Wall Street often calls every decline a change in fundamentals, when liquidity explains far more. Jim Rickards' argument suggests institutions sold gold because they urgently needed dollars for energy, not because confidence vanished. That distinction separates temporary financing pressure from a lasting collapse in value. Investors who confuse forced selling with failed fundamentals frequently exit near major bottoms. Next, Jim Rickards exposes how systematic traders amplified a move they never actually started.
So you needed a trigger, which was sell gold to get dollars to buy oil. But then everything else just almost happens automatically, like, start a small avalanche. The next thing you know, the whole mountain's collapsing. So we are where we are. Now, what does that mean for the future? Well, about, let me see, it was a while ago, about 14 years ago, I was in the Dominican Republic, and I was talking to Jim Rogers. Now, Jim is, probably the greatest commodities trader in history. He's legendary, co-founder of the Quantum Fund with George Soros. And at the time, I'm sorry, it was a little bit later than that. It was around 2014, but gold peaked at $1,900 an ounce in August 2011. It bottomed at $1,050 an ounce in December 2015. So you had a 4+ year bear market. And I was talking to Jim kind of in the middle of that decline. And I just said, we were having drinks down in the Casa de Campo. I said, Jim, what do you think? He said, well, I own gold. I'm not selling. I'm just going to sit tight. But then he says something I'll never forget. He said, no commodity goes to the moon without a 50% drawdown along the way.
The hardest investment decision is often refusing to react during maximum fear. This is where Jim Rickards' thesis shifts from short-term price action toward long-term commodity behavior. Deep corrections are uncomfortable, yet history shows they frequently reset powerful bull markets instead of ending them. Patient capital usually outperforms emotional capital when volatility becomes unbearable. Next, Jim Rickards reveals why one legendary trader expected brutal pullbacks before extraordinary gains.
And if you're not prepared for that, you're in the wrong market, because that's how commodities trade and that's how gold trades. Well, I said, okay. So I took that and I said, because you got to pick a base if you're going to do percentage increase and decline. So I took a base of $250 an ounce in December 1999. That was the end of the long bear market from January 1980 to 1999. I said $250 an ounce. So I took $250 an ounce up to $1,900 an ounce. That was August 2011. I took half of that, subtracted it from the peak to get the bottom, according to Jim Rogers, and I came out with 1070, and it bottomed at 1050. I mean, he was like right on the money, but he told me this in advance before it happened. So I was like, okay, nice going, Mr. Rogers. You got it right. But it was a 50% drawdown, and then it turned around, and then it went up to over $5,000 an ounce just a couple of months ago. Now, in fractal mathematics, there's something called scale invariance. And what that means is that if I give you a 1-week chart of the stock market, and I give you a 10-year chart of the stock market, and I take away the dates and just show you the charts, they look the same, meaning patterns repeat themselves at different scales, different indices, different time frames, but the pattern repeats. So let's take Jim Rogers' rule.
Most investors trust forecasts only after the market proves them right. Jim Rickards notes that historical market structure often repeats because investor psychology rarely changes across cycles. Recognizing recurring patterns does not eliminate risk, but it can prevent emotionally driven decisions during extreme volatility. Those who understand market rhythm are less likely to surrender quality assets near exhaustion lows. Next, Jim Rickards unravels why today's correction may already satisfy that historical pattern.
Which he was spot on, and apply it to today. Well, we got to pick a base. I picked, I think around 1850, which is a few years ago, up to 53.55. So here's my base. Here's my peak. Take half the difference, subtract it, comes out around $3,600 an ounce. Now, I'm not saying gold's going to go to $3,600 an ounce, but seeing it go to $3,900 an ounce and now around 4,000, like, yeah, that's how it goes. And if you don't like it, you're in the wrong place. But what it also means is that we're at the bottom of that cycle, at or near the bottom of that cycle, and we're paused for, as Jim Rogers put it, going to the moon. So I'm standing by my $10,000 an ounce forecast, late this year, sometime in 2027. We'll see is the exact timing, but, kind of intermediate term forecast. But that would be completely consistent with a drawdown and then a major bounce back, as Jim Rogers described, as the data supports. So yeah, this is a very good entry point.
Thank you so much for that, Jim. So if you could talk a little bit about silver and mining stocks. People usually, if they want some leverage on gold, they look at silver and mining stocks. Would you expect during this next run, gold to silver ratio to get narrower?
Consensus usually declares a bull market dead, just as downside momentum fades. According to Jim Rickards, today's correction fits a historical template rather than an extraordinary collapse. The uncomfortable possibility is that fear has become more extreme than the underlying fundamentals justify. Investors waiting for perfect confidence often discover the opportunity disappeared months earlier. Next, Jim Rickards reveals why silver and mining shares could react very differently than gold.
And if you look at mining stocks, Jim, I mean, with the current commodity prices, they look very comfortable. We have seen some financial reports come out recently, and they're gushing cash right now. Do you find them attractive as well?
Yes, I'll talk about silver briefly. By the way, I own silver. I own gold, but I also own silver. I don't spend as much time analyzing silver as I do gold for two reasons. Number one, silver is a little more complicated because it is a precious metal and it responds to the trends we've been talking about, but it's also an industrial input, a big one in terms of catalytic converters, electronics, and a lot else. So if you're trying to analyze silver, you have to look at both, and you can be in a world where they're both going up, precious metals are rallying, and the demand is enormous, or one's up and one's down, or vice versa, or they're both down. So it's just a little more complicated in that sense. Although I will say that silver follows gold with a lag. So if gold performs the way I just described, and I believe it will, then silver is going to do just fine. Whether it gets to $150 or $200 an ounce, we'll see. I don't focus on the ratio too much. I look at percentage gains in the individual asset class. The ratio is almost a relic from the late 19th century when the Western silver miners lobbied Washington for 16-to-1 ratio. But it was just political graft and trying to prop up the silver industry. It doesn't really mean very much.
Silver often looks disappointing, right before it accelerates beyond expectations. What Jim Rickards is highlighting is that silver responds to both monetary demand and industrial expansion, creating a more complex investment case. The dual role explains why simplistic ratio analysis frequently misses major turning points. Patient investors benefit more from understanding demand drivers than chasing historical averages. Next, Jim Rickards exposes why industrial demand could amplify silver's next major advance.
But the fundamentals do, and so if gold performs the way I described, which I expect, then silver will be along for the ride, and we'll see silver making its way up to $200 an ounce. But the industrial side of it is also there. I mean, we all know what's going on in electronics. I mean, we may see individual failures of some of these hyperscalers and data center builders as companies, but AI and electronics and that build out is not going away. So silver will be very much in demand. Miners are basically leverage bets on the underlying. Now, and the reason it's kind of almost like corporate finance. A lot of miners, and I invest in gold and silver mines, so I'm on the board of some companies. I'm familiar with the industry. They have inputs and outputs. Well, the output is what's the price of gold or silver that you're selling, or maybe copper or something else. But the inputs are electricity is a big one, and transportation costs, to rent drilling rigs, land rights, et cetera, royalties if you're doing streaming transactions, et cetera. Well, a lot of that was put in place for the mines currently past the exploratory phase, getting into production. A lot of that was put in place when gold was below $2,000 an ounce. So even at $4, I understand $4 is down from $5 or more, but even at $4, it's still double where they thought it was when they committed their.
Technology demand may fluctuate, but strategic metals remain essential regardless of market sentiment. Jim Rickards' argument suggests miners now enjoy stronger economics because many production costs were locked in before gold surged. That margin expansion is often overlooked while investors focus exclusively on metal prices. Institutional money frequently notices improving profitability long before retail participation returns. Next, Jim Rickards reveals why operational leverage can dramatically magnify future shareholder returns.
Cost of energy prices have gone up. I'm not saying those costs are all constant, but the ratio of the margin, it's the margin that you're going to get from today's prices, even with the drawdown relative to your input costs, has greatly expanded, number one. And since these are stocks and not physical bullion, there's a multiple. So when the margin goes up, which it has, it all goes to the bottom line because you have fixed costs, there's some variable costs, but they haven't gone up as much. So if the cost side is under control and the revenue side is going up, the margin, the increase in the margin goes straight to the bottom line, and the market will give you a multiple of 10 or 20 or sometimes more. So this is just financial accounting, but the point being, a gold or silver mining company is a leverage bet on the underlying. Now, there is a variable very hard to account for, which is management, meaning the math works and the financial accounting works the way I just described. But you have to, as an investor, you have to ask yourself, is this a well-run company? Has the CEO done it before? Do they have a track record? Are they in a place that's going to get expropriated by a foreign government, or are they in a good place like Alaska or Nevada or someplace? I'm not saying it's easy. There are a lot of things you have to look at, but the fundamental economics of fixed costs versus variable revenue and revenue going up and increased margins and market multiples, that's a given. So yeah, I do like the sector a lot.
A rising gold price alone does not determine mining returns because management execution ultimately decides who captures the upside. This is where Jim Rickards' thesis shifts from commodity prices to disciplined business analysis. Strong margins create opportunity, but poor leadership can still destroy shareholder value despite favorable markets. Careful stock selection matters as much as owning the right sector.